Long before anyone contemplated Tesla stock, CEO of ARK Invest, Cathie Wood has always been a firm believer in the company and its future. Cathie Wood has continuously expressed optimism on Tesla's shares, but Cathie Wood is issuing a stark warning to other investors in Tesla stock today. Astonishingly, Wood recently sold a portion of her Tesla investment. However, if you have been paying careful attention to her for some time, you are aware that this is all a part of her disruptive innovation strategy. Nevertheless, Wood offers some advice to Tesla shareholders that might have a big impact on the company's stock in 2022. Why does Wood find the stock price of Tesla concerning? What cautions does she issue? In this video, let's find out. Many experts and analysts believe that 2022 will be a big year for Tesla, the business that makes all electric cars and battery storage systems, in light of the events of 2021. Tesla made a few significant announcements in the previous year. For instance, the business declared that it would open gigafactories in Austin and Berlin by the end of 2021. Tesla was unable to fulfill its claims due to a few setbacks, particularly in Berlin. The Berlin factory, the Brandenburg, was scheduled to open in 2021, but was unable to do so because to a number of issues, including opposition from environmentalists and issues with the government. Although it hasn't been formally inaugurated yet, the Tesla factory in Austin, Texas, is completely constructed and appears to have started hiring new employees. In any case, Musk's revised forecast of an early 2022 opening is anticipated to be met by the new plants, which were not disclosed in 2021. It is anticipated that the opening of these factories would result in a notable boost in Tesla's vehicle production, both in terms of quantity and speed of delivery. For Tesla, this is a big step forward in their efforts to boost car production and expand into new markets worldwide. More sales and profit from Europe would result from a factory in Berlin, much like the Shanghai factory did for the corporation in China. The business would be able to release the Cybertruck, their most anticipated vehicle, to yet from the Austin plant, which is known as the Cybertruck factory. The mission of Tesla is to make the world a greener place. In order to further their goal of a cleaner Earth, they have been developing energy and energy storage technologies, in addition to producing cars that operate on renewable energy since 2008. In addition to the plants, Tesla has a ton of other plans for 2022. Because they anticipate that Tesla's stock will rise in the upcoming months of 2022, many investors are keen to purchase the company's shares. Even though the company's stock price is currently down at $965, a lot of individuals are still wanting to invest since they believe a rise is imminent. However, you might want to hear what veteran Tesla optimistic investor Cathie Wood has to say to Tesla investors before you act. Wood updated her 2025 stock projection in a piece she wrote regarding Tesla stocks. Now, let's speak about Cathie Wood and what she believes to be the biggest risk facing the economy and stock market in the run-up to 2022. Deflation is the biggest concern, in Cathie's opinion. Certain stocks in the stock market are in a bubble because their primary goal is to satisfy investors by issuing dividends. As a result, they aren't making investments in innovation, which may have an impact on them in the future. Based on Wright's Law, ARK's analysis makes a strong argument for good deflation over the long run. Deflationary pressures will be unleashed by 5 innovation platforms, which will build up over time and impact every area, industry, and company globally. Wright's Law states that there will be a 28% reduction in costs for each cumulative doubling in the number of whole human genome sequence with long-read methods. By contrast, there will be a 40% decrease in those associated with short reads. Comparably, expenses are cut by 50% and 28%, respectively, when the number of industrial robots and batteries produced is doubled. Training in artificial intelligence is becoming 60% less expensive annually. As these platforms merge, S-curves reinforce one another, potentially leading to even larger cost savings. For instance, current research indicates that by 2030, autonomous taxis with large development potential would arise from the convergence of robotics, energy storage, and artificial intelligence. With productivity improvements from time spent not driving the wheel, autonomous taxi networks might grow their revenue from $0 to $9 to $10 trillion globally. This could add up to more than $20 trillion. Much more controversial is the cyclical thesis for deflation. Debate has been stoked by supply chain bottlenecks that have persisted far longer than most of us anticipated, and the University of Michigan Consumer Sentiment Index has fallen to levels not seen since the coronavirus crisis. Consumer spending on goods, which makes up about 1/3 of all U.S. consumption, increased as stimulus payments drove the savings rate to 33 in the spring of 2020, destroying businesses that had shuttered prior to the coronavirus. Due to worries about trade between the US and China, as well as an inversion of the yield curve. In the latter part of summer 2019, businesses were already in a risk-off mindset. Early in 2020, number of people hoarded merchandise using government stimulus cash while businesses closed, which resulted in an increase in the amount of inventory in their garages and homes. Fearing that the shelves would be empty for the holidays, consumers started their shopping early this year. This increased the CPI inflation rate to 6.8 in November 2021, which made certain supply chain issues worse. Consequently, it is anticipated that demand growth would sharply slow down during the following 3 to 6 months. Just when supply chain bottlenecks release, thereby putting businesses in the position of having excess inventory. If ARK Invest is right, the market will probably be more concerned about the likelihood of a recession in the US, sharp slowdown in China's and developing markets economy, and an unanticipated drop in inflation during the next 3 to 6 months. Red in several commodity prices already, precisely because of China's real estate turmoil. Iron prices have fallen by 36, while the Baltic Freight Dry Index has fallen by 39. Dram costs have decreased by 27, while US lumber prices have decreased by 35. Even the price of oil, which up until recently was a notable aberration, has decreased by 15. As an investment officer, Cathie Wood, who has been in the stock market since the 1970s, noted that most of her clients end up selling their shares of a stock for pitiful prices, or, as she put it, selling for near the bottoms of the market cycle. When they see that a disruptive innovation strategy has fallen out of luck, even, or at the very least, maybe from negative headlines in the media, she thinks that through this procedure, the client would make a loss that was only meant to be temporary into something permanent. For this reason, investment companies such as Wood's ARK Invest concentrate on 5-year investment horizons. They keep their consumers informed throughout this period to prevent them from making any mistakes. Their main takeaway is that over the next 5 to 10 years, innovation will significantly enhance people's lives by solving problems. ARK Invest concentrates their portfolios on the stocks in which they have the greatest conviction, taking advantage of volatility amid falls. Numerous broad market indices have reached all-time highs, moving away from growth businesses and towards defensive and value stocks such as the FANG's Facebook, Apple, Amazon, Netflix, and Google since mid-February 2021. The key reasons for this shift are fears that inflation may not be a temporary issue brought on by supply chain limitations, but rather the result of overreactions in monetary and fiscal policy due to the coronavirus and its consequences. Value stocks in industries like energy, financial services, industrials, and minerals tend to benefit from inflation associated with strong economic cycles. And meanwhile, by raising discount rates and lowering the current value of future cash flows, rising interest rates may be detrimental to long-term assets like aggressive growth stocks. Despite selling Tesla shares, Wood doesn't appear to be concerned about the current stock market direction, and Tesla still makes up the majority of ARK Invest's owned stocks. Cathie Wood thinks there will be a significant shift soon. She thinks that traditional investment tactics would not work, and that the global order will shift. ARK Invest has been the talk of Wall Street for the past several years after outperforming the market and securing a position as one of the major participants in the financial sector. This investment company was founded and is led by Wood, who has drawn comparisons to rising star Warren Buffett. In an attempt to capitalize on the success of the big dogs, many traders try to imitate the strategies of well-known investors and brokerage houses. What are your thoughts on Cathie Wood's investor warning? Please leave a comment below.